Right now, somewhere in Argentina, someone just watched their life savings lose 30% of its value in a single year. Meanwhile, in the United States, that same dollar bought more coffee, more gas, and more imported electronics than it did 12 months ago. Same year, same planet, completely different outcome. And here's the part that should bother you. Most people have no idea why this happens. They think currency value is random. It's not. It's one of the most predictable systems in the entire global economy, once you understand the four forces actually driving it. By the end of this video, you'll understand exactly why the dollar rises, why it falls, and, more importantly, how to position your own money so you're never on the losing side of it again. Let's get into it. Why this actually matters to you. Before we break down the mechanics, let's kill a myth. Exchange rates aren't just something that affects tourists and Forex traders. If you've ever noticed gas prices creep up even when oil supply hasn't changed, if you've ever wondered why your favorite imported product suddenly costs more, if you invest in international stocks, or you're planning to travel, or you just want to understand why the news keeps saying the dollar is strong, like it's a good thing, this affects you directly. A currency isn't just paper. It's a real-time report card on a country's economy. And the four forces we're about to cover are the exact same forces that move stock markets, interest rates, and your own purchasing power. Force 1: interest rates. Here's the simplest way to think about currency. Money goes where it's treated best. When the Federal Reserve raises interest rates, it's not just making mortgages more expensive. It's sending a signal to every large investor, bank, and hedge fund on Earth. If you park your money in US dollar assets right now, you'll get paid more for it. So what happens? Investors from Japan, Europe, and emerging markets start converting their currency into dollars to buy US bonds and earn that higher yield. That buying pressure increases demand for the dollar. And basic economics says when demand for something rises, its price rises too. This is exactly what happened in 2022. The Fed aggressively raised interest rates to fight inflation, and the dollar surged to a 20-year high against nearly every major currency. Meanwhile, countries like Japan kept their rates near zero, and the yen collapsed to its weakest level in decades. The lesson: interest rate differences between countries are one of the single biggest levers moving currency markets, and they move faster than almost anything else on this list. Force 2: inflation. Inflation is the silent currency killer, and it works almost like a leak in a tire. If prices in the US are rising 3% a year, but prices in Switzerland are only rising 1%, the US dollar is slowly losing purchasing power faster than the Swiss franc. Over time, that difference compounds, and traders price that decay directly into the exchange rate. This is why countries battling runaway inflation almost always see their currency crash at the same time. Turkey is the textbook example. Between 2021 and 2023, Turkey's inflation spiraled above 80% in some months, and the Turkish lira lost more than 80% of its value against the dollar over that same stretch. It wasn't a coincidence. It was cause and effect. Low, stable inflation is one of the biggest reasons the US dollar has historically held global trust. Even when people criticize American fiscal policy, the dollar's inflation track record is more stable than most of the world's currencies. Force 3. Trade balance and supply versus demand. Every currency is a product, and like any product, its value comes down to supply and demand. When a country exports more than it imports, like a trade surplus, foreign buyers need to purchase that country's currency to pay for those goods. That constant buying pressure strengthens the currency. China is a perfect example. For decades, China's massive export machine created enormous global demand for the yuan, which is part of why the Chinese government has had to actively manage, and sometimes deliberately weaken, its own currency to keep exports competitively priced. The U.S. is actually the opposite case. America runs a large trade deficit, importing far more than it exports. In a simple world, that should weaken the dollar. But the dollar stays strong anyway, because of our final force, and it's the one almost nobody talks about. Force 4. The safe haven effect and global trust. The US dollar isn't just America's currency. It's the world's currency. Roughly 90% of global Forex trades involve the dollar on one side. Oil is priced in dollars. Nearly 60% of all foreign central bank reserves are held in dollars. And when global uncertainty spikes, wars, pandemics, banking crises, investors around the world do the exact same thing. They rush into dollars because it's still seen as the safest asset on the planet. This is why the dollar often gets stronger during global crises, even when the crisis originates inside the U.S. During the 2020 pandemic crash, and again during 2008's financial crisis, the dollar spiked in strength. Not because the U.S. economy was thriving, but because in moments of panic, capital runs toward the perceived safest harbor. Right now, that harbor is still the dollar. This reserve currency status is arguably the single biggest reason the dollar breaks its own economic rules. And it's also the reason so many economists are watching closely to see whether that global trust holds over the next decade. What this means for your money. So how do you actually use this information? If you hold investments in foreign markets, currency swings can silently eat into or boost your returns, completely separate from how the underlying stock or asset performs. If you're planning international travel, watching interest rate decisions from the Fed can help you time your trip for a stronger dollar. And if you're building any kind of online business or earning international income, understanding these four forces helps you predict, rather than react to, currency shifts before they hit your bank account. The people who build real wealth aren't the ones reacting to headlines about the dollar crashing. They're the ones who understood these four forces long before the headline ever hit. For forces, interest rates, inflation, trade balance, and global trust. Master those, and currency movements stop looking random. They start looking exactly like what they are, predictable economic signals hiding in plain sight. If this broke down something that always confused you, hit subscribe. Every week we take a complicated finance topic and make it make sense. And drop a comment. Which of these four forces do you think will matter most over the next few years? I'll pin the best answer. See you in the next one.